All right, folks, we've got about 3.5 minutes until we start. 3.5 minutes until 10 a.m. Eastern Time. All right, good morning, Checkmate crew. It's 30 minutes after the opening bell of New York Stock Exchange at 10 a.m. Eastern Time on this Wednesday, December 7th, 2022. It's Mickey Blindside here with your market memo. Okay, let's just go over real quick. It's the week before options expiration next week. It is next week, right? Yes, it is. Okay, so next week we've got OpX. Options expiration. It's also quad witching, so there's dividends being paid out. Options prices are accounting for that dividend. So if you guys want to manage some risk, this is probably the time. Probably not now, but next week. You probably want to get out before all the dividends get paid out. But let's just go over what's going on. So we actually saw some selling yesterday. Okay, we saw an outsized move in the VIX compared to the sell-off. I mean, the VIX was up almost 7%, and while the market, and it's also, VIX is also in the 20s, guys. So but the market only went down less than 2%. So we're seeing those outsized VIX moves. We actually talked about this in the summer, where we started to see the data show us that we might see the VIX come back. Remember, in the summer, we had this dash for cash. As interest rates went up, there was this alternative. And so a lot of institutions, instead of hedging and buying puts, they actually sold a lot of shares to raise cash and then make their 4% on the bond market. Now we're actually seeing those outsized VIX spikes whenever the market pulls back. That means hedging demand is coming back. And remember, back in October, since October, we actually saw a lot of institutional buying in shares. So all those new shares are probably is what causing this demand for hedging. And so we're seeing the VIX, spike up. Right now it's already up almost 3%, but the market is only down 0.3%. So again, we're starting to see that these outsized moves in the VIX, hedging demand is coming back into the market. We shall see if this continues. If this continues, then most likely sometime next year, we're probably going to have a rolling bull market, a mini bull market in between a longer term bear trend. Okay, so that might last, a few weeks, possibly even a few months. Okay, again, I'll believe it when I see it. Okay, the setup in the data is there. It doesn't mean it's happened yet. Okay, of course, in order to bet live money on that, we're going to want to see some confirmation on that. Okay. But the setup is there. Okay, the setup is there. Speaking of OPX, let's take a look at options positioning for OPX. This is the S&P 500 index options chain. This was taken this morning right before the opening bell. So as we can see here, the open interest only updates once. It updates around midnight. So this is for after all of yesterday's transactions. And we're actually seeing, look at these put walls. Look at these major put walls. We are extremely hedged for next week. Now, next week is options expiration, end of the year, and quad witching. But guess what else is next week? That's right, the CPI report on Tuesday and FOMC on Wednesday. So it is going to be a crazy week next week, all right? Make sure you get a lot of rest over the weekend because you're going to need it, okay? Especially if you're an active trader, next week is going to be a jam-packed week with data, with trades, probably a lot of volatility in both directions. So make sure that you're mentally prepared for that. But we are under some major put walls. This put wall right here, that's right, it's 154,000 on the SPX, not SPY. We're talking about SPX. The nominal value of an SPX options contract, it's 10 times more than an SPY contract. Okay, so nominally, it's like there's 1.5 million puts open interest right here on 4,000 around, let's say 400 or so on SPY. That's the SPY equivalent, okay? But on SPX, 154,000, 33,000, 35,000. So we're under some major put walls. If the VIX decreases, we're probably going to see market makers having to cover their shorts. Now, just a reminder for all of those that are not as familiar with options, when market participants buy puts, okay? And so, usually most institutions are long on equities and they hedge using puts, okay? So whenever market participants buy puts to protect their portfolios, the market maker has to sell them that put, which is a bullish position. To offset that bullish position and to remain delta neutral, they have to short some of the underlying, usually a futures contract or SPY shares. They have to short the underlying to be delta neutral, all right? Now, as time progresses, the deltas on those out-the-money puts decrease, all right? Especially out the money, but also in the money as well too. But the deltas start decreasing. So when the deltas start decreasing, the market maker will have to cover some of their shorts again to remain delta neutral. Now, if those market participants decide to cash in their puts, then we're going to see buying en masse in order to remain delta neutral by the market maker. Okay, so again, we're very hedged for next week. Again, I presume it's because of the CPI and FOMC. If next week the CPI comes out lower than expected, if FOMC, nothing crazy happens, we could see the VIX fall. And if the VIX is falling, we could see a squeeze up into the 4,000s at some time next week. All right. In order for the markets to keep going down, we're going to need the VIX to go up. All right. The VIX needs to keep marching higher in order for us to stay at these levels or go lower. Okay, so there's no need to guess. Somebody asked me, when I mentioned that on the Discord, somebody asked me, are you then predicting that this is going to go up? Well, we don't have to guess. We'll just look at the VIX, and the VIX keeps going higher and higher. Most likely the market's going to go lower. Again, when VIX is going up, it means a lot of participants are buying puts. Market maker has to sell those puts and has to short the underlying to stay delta neutral. If VIX is dropping, we're seeing delta decay on these puts. Market maker will have to buy some of the underlying in order to remain delta neutral. Okay, and so that's the dynamics of active options hedging by institutions on the S&P 500 markets. Okay, so that's something to watch out for if you're a day trader. It's a really good idea to start looking at the VIX. These options expiration levels for monthly options expiration are going to be more important, and the effects are going to be stronger and stronger as we get closer and closer to options expiration. I presume that this week and next week, we're probably going to chop around big moves in both directions, okay? Another reason why we're also seeing a lot of chop is because of the end of year tax loss harvesting and tax selling. So yesterday, this is something that I noticed, while I was researching block trades and big institutional orders yesterday on the market. We saw heavy selling in a lot of oil stocks. Okay, so let's take a look at XLE. We saw a huge drawdown in XLE. At the same time, we saw a huge drawdown in semiconductor stocks. There was a pair trade. These were pair trades. And if you actually line up the big orders, it lines up actually quite well. So what I think is happening is right now, institutions are selling their winners. And what's the winner this year? It's energy, right? Come on, it's commodities, energy. That's the stuff that's been winning this year. All right. Take a look at 2022. From 2022 forward, start of 2022 is right here. XLE has gone up, tremendously, around 50-60%. All right. At the same time, the semis have lost a lot of value. Again, inflationary times, tightening, less liquidity, and higher interest rates pushed down the semiconductor space by about a third or so. All right. So basically they're selling off their losers to offset the gains on their winners so that they can keep more of their earnings. Okay. A lot of fund managers, this is what they do at the end of the year. Okay. This has been observed. This is not something new. This is not something I came up with. This has been observed for the last 100 years in the market. Okay. This is something that always happens. Okay. So we're starting to see that pair trade. Metals was also involved as well too. Metals, one could argue, a lot of that was due to the dollar. It could be, but metals has also been a decent winner this year. I'm sure there are some people who took profits on this as well too, but not so much. As far as a pair trade is concerned, the biggest pair trade I saw was in energy stocks and in semis. Okay, so what does this mean? We could actually see this continue for the rest of the year. Okay, we could see this continue. All right, and what would happen then is that the S&P 500 would chop around this big range. So not only is the options market kind of showing us that we're going to chop around in the big range, but also just seasonality is telling us we might see that choppiness. And again, it's because we're selling winners and losers. All right, and rebalancing those positions and harvesting those losses. And so I think we're going to see a lot of that. I think if the 10-year Treasury rate keeps going up, this is going to intensify, okay? I think if interest rates keep coming down, then this is probably more going to be a more muted tax loss harvesting season, okay? So it really depends on the 10-year Treasury rate because usually the 10-year Treasury bond is what is used for collateral. So if that collateral value keeps going up, meaning rates are coming down, the yields on the 10-year Treasury bonds are coming down, it means that there's going to be less of a demand to do this loss harvesting. Whereas if the value of the collateral, the 10-year Treasury bond goes down, meaning yield goes up, we're going to see a little bit more demand to do this harvesting, okay? I think next on the list is probably something like the industrials, okay? Industrials have been doing well too. Well, not all the industrials, but, specifically like, Caterpillar and these kind of names. I don't know. Did Boeing did well this year? No, not so much. Okay, so we might see more of that. We might see in the metal spaces, that happening. Metals have been doing actually very well as well too. So we might see more of that happening as we get closer and closer to the end of the year. So that's something I noticed. I think it's going to confuse a lot of people. And a lot of these moves. A lot of people rely on their TA or their charting. I think a lot of your levels can get overshot, and you might see certain lines get violated only to have it get back in next day or the day after. You might see a lot of that in the next couple of weeks, okay? So just a warning for you guys out there. I am starting to see those pair trades, and when I see those pair trades, winners and losers getting sold off at the same time, it means it's tax loss harvesting. And again, it happens around this time. Usually actually happens around November, but this year for some reason it's happening just a little bit later. But it is what it is. I mean, the markets will do what the markets will do, okay? So I just wanted to clear that up. Speaking of energy and oil, oh my goodness. Yesterday, what a huge drawdown in oil, okay? I heard some rumors that some hedge funds got liquidated in this move. A lot of hedge funds apparently got leveraged long on commodities and energy names, as that was the only thing that was really working very well this year. They over leveraged long, and then when we started seeing this pullback since the summer, a lot of them got into margin calls and got liquidated. And there's some rumors right now that this is this move is based on some hedge fund liquidations. We shall see. Whenever the hedge fund liquidations do happen, we usually hear about it days or weeks after it happens, okay? As the trades settle and as windows get shuttered and things like that. So we'll see what happens, but it does appear as if that may be the case. That may be, but I think more importantly than anything else in the oil market is this. It's the crack spread, that gasoline crack spread, the diesel crack spread. It is making lower lows. I mean, the gasoline and distillates are making lower lows now. This does not incentivize refineries to buy oil to produce distillates. Okay, there's just less of an incentive to do that. If your profit margins are shrinking and shrinking and shrinking, why would you spend money on oil to make a product that you're making less money on? Okay, you're getting less incentive to do so. I think if gasoline just keeps coming down and down and down, at some point refineries, I mean, if gasoline comes down enough, I think refineries will be forced to sell futures contracts on oil just to hedge at that point, hedge their supply, okay? Which means we could see crude oil dump even more. I mean, we could see it go down to 65 or so. We shall see. Although it does look like, doesn't it look like if it ends green for the day, that does appear to be an exhaustion signal, does it not? It means that sellers could be exhausted. I don't know. We'll see at the end of the day if that's what it is. I'm not going to guess on what happens. If it shows me an exhaustion signal, then it shows me an exhaustion signal, but it isn't until it is, and we won't know until the end of the day, okay? So this is something to look out for. If you're active in the energy space, I would definitely take a look at this. You would want to also see that in gasoline as well. You would want gasoline to, form that huge wick and end with a green candle right here for the day, okay? And again, we won't know until later today at closing. All right, so for you energy traders out there, this is something to look out for. RB, RBOB on some other brokerages, but that's the gasoline futures. Also look at crude oil as well. Look out for that daily candle at the end of the day. All right. Speaking of energy, let's also, while we're in this energy topic, let's talk about nat gas. I mean, the more I do research on this, the more I think that, natural gas you know, I'm getting more and more bullish on this the more research I do. So I am really looking for a pullback in some of these natural gas names. One of the natural gas names that we're trying to get into, although they're not a producer, is a tanker, a natural gas tanker and container company. I think, you know, again, the thesis here is that there's a lot of cargo container ships that need upgrading. The new ones that are being built right now are very, very expensive, and they're not going to be operational until 2026, 2027. So these companies that have newer ships and more eco-friendly ships, more modern ships, they're going to command more of a premium in their rates, okay? So, and also too, just rates in general are probably going to increase as there is that shortage in shipping. And again, we talked about our thesis in shipping before, and if you click on the top right corner, that exclamation point, I'll put some links to our previous videos where we talk more in depth about the cargo and maritime shipping thesis that we have. But you know, then that right now, you know, we're kind of also, you know, that the maritime company that we're trying to get into also has that natural gas and hydrocarbon exposure. So that's why we also saw it go down as well too. FLNG, I'm ready to get in when it gets to 33.36. When it gets to 33.36, I'm getting into some leaps. And again, Discord, I'll let you guys know, you know, what strikes and everything I'm looking at. Right now, I'm looking at January 2024's, possibly January 2025's in the money leaps. I'm looking for Delta 65 to 75. And then I'm going to be selling poor man's covered calls against it. But anyway, so natural gas right now, you know, if you look at natural gas, oops, I forgot. Trading View does not require that little front slash in futures. Anyway, natural gas futures, it did draw down as well too. We're seeing a little bit of a bounce today. But this chart obviously looks very different than the European natural gas chart. Okay, the European natural gas chart, if you actually look at it on a weekly basis, is starting to make an uptrend again. It is actually maintaining, and that was wrong vernacular. It is still in an uptrend. It's not making an uptrend again. It's always been in an uptrend, at least since around 2021. Okay, it's been in this weekly uptrend. It's still maintaining it. It made a higher low, and it's already coming back up. We, you know, about a month or two ago, everybody was saying, oh, we're expecting a milder than expected winter in Europe. How do they know? How did you know 2 or 3 months beforehand that they were going to have a milder winter? It made no sense to me. And so a lot of natural gas names actually started selling off before then. Also, we saw a selling in natural gas futures because of that. And I thought that's the most ridiculous thing. How do they know that that's going to be the case? I mean, perhaps they have some statistical modeling, this and that, yada, yada, yada. But, oh, well, look, lo and behold, last week or the week before, now they're reporting a cold snap in Europe. And so now everybody's, scuttling around, and trying to, now they're worried about the natural gas supplies in Europe. So we're actually seeing some pressure in the European stock index because of this. We will see there's some fears, although it is actually recovering most of its losses for the day. We are seeing it pull back a little bit because of that. I think if natural gas, especially the European futures contracts, the ones that are traded on Eurex, if it keeps going up, all right, and if it just keeps roaring higher, I do think that's going to put some pressure on the Euro stock exchanges, the Euro stock indices. We're still in our FEZ puts trade. I'm still in it. It's all paid for by our UVXY puts that we had a few weeks ago. Remember the December 7 puts? We bought it at 8 cents right before the last FOMC, and we sold it for about 27 and 21. So those gains actually paid for all of this. So I'm willing to let it run, but it'd be nice to get a payout on this. I think it's going to take a few weeks. Let's see what happens when that cold snap either worsens or what, or if we see, the gas supplies decrease, we could really see the European stock exchanges sell off. This is acting as a hedge as well too, something that has a little bit of a negative delta for, all the shares that we're acquiring. So I'm willing to keep this open. And also too, the dollar, if the dollar also keeps going up as well too, we could see, the euro currency getting pressured. And if that's the case, we might see also, again, more selling, more of a headwind in European indices. We're still at that level here. I'm still in my UUP, which is the dollar index ETF. I'm still in those January 2024 calls for around the 30 strike. We got a little bit of a profit on there. We did see the IVs increase on the longer dated contracts, which means a lot of participants are betting on longer term volatility and the dollar. So even though we're lower on UUP than when we entered the trade, because of the IV increase, we're actually profiting from that. So I guess we got a little bit of stroke of luck there. So we'll see if it bounces or not. I do think it's going to bounce. And, I've already set my levels right here on the dollar index. I'm going to take half my profits on these calls. If they get to 107.75 or so, 107.70 to 107.75 on the dollar index on half. And then the other half, I'm going to wait till 109.70. Okay. So those are my take profit levels for my UUP. And I have my alerts set. Once those alerts trigger, boom, I'm going to start selling and taking profits. Okay. I do think that this is going to be a lower high and then it's going to curve back down. At least that's what I'm anticipating. I'm not trying to predict the future. I'm just trying to anticipate what could happen just based on the data that I'm seeing right now. If it does make a higher high, well, then our FEZ puts are just going to, I think, perform phenomenally. Either way, come what may, I think we're ready based on, at least I'm ready based on my positioning. I still have lots of cash to get into some of our names that we're trying to get into on some pullbacks. So we will see what happens. I'm going to keep an open mind about this though. All right. What else? Crypto. Some of you guys asked me about crypto over the evening. I haven't gone over crypto in a while. Well, right now, if you look at the options market on crypto, it's still at around $4.8 billion in open interest on Deribit. So again, I don't think the options are going to pull or push price in any way until OI gets to around $6.5 to $7 billion. We're still ways away from that. I actually noticed that the OI is decreasing as time progresses. So we'll see when speculation comes back or when active hedging or whatever comes back into the Ethereum derivatives market. As far as levels are concerned, I mean, we're just kind of like towing the line on this level right here, this important zone, this 1241.46 zone. We use that as a buy. Thank goodness we took some profits at the highs. But I no longer have a position on this anymore. But we'll see what happens. We are getting closer and closer to that ETH gold line. That ETH gold line is not too far away. So if the Ethereum does pull back a little bit, all right, if it pulls back just a little bit, or if gold just shoots up, I guess, we could be hitting that line pretty soon. We shall see. And again, I got alerts ready and I got some orders ready. So right now, based on gold price, that would be around 955 to 1,000 in Ethereum per coin. If we get to that zone, I'm willing to buy right there. That's the zone we've been waiting on for. How long have we been waiting in? We've been waiting for that since like July, August. Okay, so we'll see if patience pays. Usually it does. That's really what I'm looking for here. Okay, that's the zone. That's the only place that I'd be interested into buying Ethereum is right there. All right. What else? Our liquidity data on our junk bonds ADL line. Our junk bonds ADL line is actually staying quite stable. Surprisingly so. It hasn't come down as much as I thought it would based on the sell-off that we had in equities. That's one, I guess, quote unquote, stronger data point. We'll see what happens. It doesn't mean as much. Okay, so we're still pretty high up. We haven't seen like a huge gap down on the S&P 500. Trend reversals in junk bonds ADL does take time, and so it takes time on the U.S. indices as well. Unless we get some type of shock event in the market where some unknown risk happens. But outside of that, this is not going to turn suddenly. There are some data divergences. So even though the junk bonds ADL line is stable, the New York high-low line actually tumbled a little bit and actually went below our moving average. And yesterday I said the New York high-low line was a little bit stable, but after checking again and looking at the moving averages, it's actually below. And today, if we go negative on the New York high-low line, which we are negative right now, we're actually going to go below all the moving averages again, which is actually, that means liquidity is actually shrinking again. And one other data point that we use is the New York advanced decline line. It actually made a lower low on the daily chart. So the New York AD line, the New York Stock Exchange advanced decline line, is actually decreasing now, making a lower low on the daily chart. So market breadth is decreasing right now, which is not good for liquidity. Okay, so we're actually starting to see market breadth actually falling right now, which is very interesting. At first I thought, just because of the junk bonds ADL line was stable, I thought that was a positive development. But after looking at everything else, we're starting to see now weaknesses form in the market. So that's very interesting. So maybe it's going to be the markets are, the SPX has been rising for, let's say, a few weeks now. Maybe this is a buy the rumor, sell the news kind of a thing with FOMC. Everybody's expecting, the Fed to be, less hawkish, and then they do a 50 basis point rate hike, which is on the low end. It was a debate between 50 and 75, and now that it actually the 50 basis points happens, maybe we see hedging demand come back. Again, the VIX is going to have to go up a lot for the markets to come down on this options expiration, just because of all the put walls that we have. But it's possible if hedging demand outpaces all the cashing of those puts, then the VIX is going to go up and the markets are going to come down. It is what it is. So again, I'm going to stay open-minded about that. But we are starting to see cracks in our liquidity data. New York advanced decline line is showing us lower breadth, decreasing breadth, and also the New York Stock Exchange high-low line, which is the 52-week, the stocks that are making 52-week highs minus the stocks that are making 52-week lows. That is also decreasing as well too. And again, today it's already negative. So if it closes negative for the day, we're actually going to be below all the moving averages, which is usually a sign that the bear market is going to continue. Okay. So I just wanted to make sure you guys knew that as well too. So keep that in mind as you plan your trades for the rest of the year. Anything you guys want to look at? Oh, you know what? Yesterday, somebody from YouTube or one of our social media channels asked about First Majestic Silver. And I did a little bit of research yesterday. You know what? I don't, I get it. There's a lot of interest in this. And, I know a lot of metals traders that are getting involved in AG. But I just don't like the fundamentals as much. Their earnings is not that great. They're still losing money quarter to quarter, and they have a large amount of debt, okay? And so that, with a rising interest rate environment, that's just, I don't like that. Even if the industry is in a very favorable place macro-wise, I don't like companies that have a lot of debt in a rising interest rate environment, all right? And I don't want a company that's losing money, especially a metal miner, okay? They should be making boatloads of money right now, but they're not. So I don't like that. That's just me. I mean, I really look at those fundamentals, and I think the fundamentals are very important in this environment with inflation going up and interest rates are going up. The definition of an asset is way more stringent in these conditions than it is when interest rates are at rock bottom near zero. So I am going to, it does not have my blessing as a accumulation vehicle. Now, if you want to get involved, that's up to you. You know, nothing I say is financial advice. You know, you're free to do whatever you wish, but I think I'm going to stick to more of the ETFs, SILJ or SIL, which are the silver miner ETFs. I'm going to be waiting for a pullback, although it looks like it's up 2.64%, probably because the dollar is down. But I'm definitely, on the next pullback, if the dollar goes up to that 109 zone and it tops out and makes that lower high, definitely I'm going to be buying the dip on the silver junior miners. And again, I'm going to be using Leap's poor man's covered call writing. I'm going to be buying deep in the money, 1 to 2 year out, deep in the money calls, and then I'm going to be selling shorter dated out the money calls to lower my cost basis. So that's my plan still on the metal miners, okay? And I went over that more in detail. I actually made some changes yesterday too. And again, you can click on the top right link, the exclamation point. I'm going to put a link in there to yesterday's video and to other videos related to our thesis in today's discussion as well, okay? So you all can check that out. Anything else you guys want to look at? Going once, going twice. All right, in that case, that wraps up our session of the Morning Market Memo. Our Discord invitation link is in the description below. Come join our Discord, be a part of our growing community. There's no sub fees, no paywalls. It's of the people, by the people, for the people. And if you enjoyed our video, hit like, follow, subscribe, comment, show us some love, baby. All right, I'll be back on tomorrow, Thursday, 30 minutes after the opening bell of the New York Stock Exchange, 10 a.m. Eastern Time. Hope you guys have a wonderful day. Trade safe.